Ira Epstein with your weekend edition of your metals market update, and this update is for Friday, March 15th, 2019, and we're just getting on to 4 p.m. Central Standard Time. Now remember, the weekend edition is very different than my daily editions of this video, and that's because we start off looking at a monthly chart and then go to all weekly charts, trying to see if the bigger picture looks different than the daily charts for you. I think that's an important event. We're getting much closer on a U.S.-Chinese trade deal. China stepped up and bought a lot of pork last week. They didn't. That news was, I guess, known in the trade. We certainly didn't hear it in news wires, but they bought 28,000 metric tons. That's a lot that they bought. Then what they're starting to do is they have, the People's Congress ends, I believe it's today. And as it's ending, they're passing all those laws, intellectual property, protection for foreign investment, and so on, what we can do. And they've passed a host of things. They waited to the very end. The stock market looked at it, it liked it, and the market liked it in the metal markets. Now, copper was a surprise to me that it's not getting more of a pump up than it is. But if you look at the copper chart, you see that broad sideways action. We're also going to run a deficit in copper again if in terms of supply versus demand, if, and especially if China adds more infrastructure and we do a U.S. trade deal. Interesting data. I've been writing about it in my newsletter. As you can see, the dollar slipping on this news, most foreign currencies coming up for the time. On the monthly chart, this is an exciting chart. If you go back, you have the better part from 2016 to right up where you're at of sideways action if you really look at it. It shows itself very clearly in the Bollinger Bands. You see that, those black bands, you can see the sideways action. And then I've got with it the 100-week average in green, and you can see we're coming into resistance zones, and the 18-week average. If this market clears this high of last month of 1344, for the first time in a very long time, you're going to get a pattern of higher lows, higher highs into a resistance area by the 1353 and 1370 level. That's real important information. That doesn't mean you have to follow through because you failed before, but who do I think's grabbing or trying to grab control? I'm thinking it's the bulls here because the bias of the market, when you're over an 18-month moving average of closes, as you've been able to do now for the past 4 months, the bias turns up in the market. Momentum has been coming up. It's stalled right here, which I'd expect as you get close to those two resistance points. Support's pretty strong at 1276.60. When we come to just a weekly area chart of closes, you've gone from 1329.20 and you have flattened out with this break low that you got to at 1299.20, then 1229.30, and now at 1302.90. That doesn't mean it's going to hold here, but the bias is up. And that bias up is important. If the market decided to come down and crashing down, I would be screaming, well, look at the weekly support of 1279. But this market has spent some time going sideways. When we come to just a weekly bar chart, you see that you've got your spike high, then you had this break low, and what the market has done, it has strung itself between what's called a higher high and a lower low. Now, in all fairness, the market lost its uptrend way when you took out the low right here, and let me come to that. That number is your 1301.60. And when you got through that, the correction phase entered. What did the market do with that? Well, didn't stay down very long in terms of time. It refused, for whatever reason, to get down and challenge the combination of the 100-week average in green and the 18. The numbers are 1279 to 1274.30. When I put on the Bollinger tops, the market had been running that resistance. It would hit it, back away. This is classic what it's supposed to do. Hit it, back away. Then it went into a corrective mode. When we look at momentum, that's where the divergence is. The momentum is pointing down. The bias is pointing up because you're over the 18-week average, and you don't have that clean pattern of a higher high, lower low. When I come to the gold-silver ratio, we had our webinar this week, and a very good question was asked. Do I believe that this relationship is what it was, say, back in the 1960s or 70s? And I'm in agreement with the person that asked it because he didn't think so, and neither do I. What I do think it does is it gives us an idea if the metals, the base metals, are jumping into the market in a way with the metal, with the gold, and saying maybe gold, because we used to think of gold as the inflationary metal, and are the other metals yet coming alive? They haven't, and that's what I look at. I would like to see this ratio under the 18-week average for that part to occur with the market. And because it's not, when you come to the other markets, and we'll get to the silver and gold, you look at it. In the GLD ETF, the first thing I see is momentum is still pointing down. The second thing, the bias is up. So starting to get divergence because the market is staying over the 18 and the 100-week average. Another event starting to happen. I want you to look. We're getting a bullish crossover in this. You've got the 18-week over the 100. Now, that hasn't happened in a very long period of time. You'd have to go back to way back here where you had a bearish crossover. Do you see that? And the market got under that. Now we're getting a reversal of that. That's important. Traders are going to look at it, but as a minimum, how I look at it is if the market were to break there, I'd expect pretty good support at the 120.85 level. If the carryover, this crossover as I like to call it, gets moving up, are you putting into play the possibility of 127 on the longer term chart? When I come to GDX, which are the miners, you still have your divergence. And remember, these are weekly, not daily charts. You've got momentum still pointing down. On the break, the 100-week average has proven to be formidable support. You don't have, like you're getting on GLD, the crossover yet where the 18-week is getting over the 100-week. So I understand the divergence there. In the silver market, you've had a pattern of lower highs, lower lows. You've gone down for the past 3 weeks, and you've been holding the 18-week average of support. So with the close this week, even though silver's weaker than gold, it has held itself on. Now, where the market could get into more trouble is if it were to get under 1492, especially on a closing basis. But it hasn't. So while the market has had the momentum, if you will, of this market losing upside bias, it's fought a battle, and so far it's holding on right at that price. In the copper market, you had all this sideways action. If you go to the daily chart, you still have it right through here. In order to break out of that, you have to ask yourself, how? If the momentum is pointing up, can the market get over here? And then the next resistance becomes the 100-week moving average. The market pulled back, and this was February 15th. It then had its burst out to the upside. Momentum still pointing up. The pattern, higher lows, higher highs. That is bullish. This was February 26th. This isn't old data. We're only at March 15th. On March 1st, you got ahead of yourself on the upper Bollinger Band, and whether it's a daily chart, a weekly chart, the odds of staying consecutively over Bollinger Bands isn't strong. The market pulled back in, found support at the 18-week moving average, but here's what it's really doing. It's taking the sideways action and making the market what? Burst and lift the top part of the trading zone, and that is still going on. It hasn't changed at all. This is today's action. What would hurt the market is getting back under 287.70. What helps the market, because the trend is up, you've got the higher lows, higher highs, is holding on to that and keep pushing on that upper Bollinger Band. Right now it's 295.70. What's the momentum of the market doing? It is still staying strong. So this is still very much in a bullish phase. In the platinum market, you had a correction from the upper Bollinger Band, went and held, past tense, the 18-week average of closes. Momentum, which had been trying to push down, has flattened itself out. Now resistance is back up on the weekly chart at 860.50, support 816.30, and the strongest of these markets remains the palladium. While the daily chart got a bit sloppy, not so on the weeklies. You still have the pattern of higher lows, higher highs. I don't know if this market's going to be able to continue and get through 1553, but I have no reason to think it won't. It would take a move under 1489 to break this long-term pattern of higher highs, higher lows. Even then, you'd still be over that 18-week average, so the bias would stay up. Momentum has not given up a thing. On the weekly charts, I do not look at overbought, oversold. I look to see if momentum is locked in. It is to the upside. In the dollar index, we've had sideways action going on since October, November. The market just recently came up, challenged that, and has had what we call a pullback from it. Now, the market did not close underneath the 18-week average of 96.35. If it does, the bias would turn down. The trend of the dollar on the weekly chart is up. Higher lows, higher highs, but it's hit upside targets and it's paused. That's the least that I could say. If it gets under 95.71.50, it will have broken that uptrend. It doesn't mean it's in a downtrend. Support would be at 95.11. Momentum is lacking in this market. It has gone flat on you. So you put it all together, you try to figure out what to do, and that's the hardest thing for you, for me. With that in mind, let me tell you what I do each and every morning, and this is Monday through Friday. What I do is I create what's called a morning subscriber video. In this video, what I'm trying to do is answer your questions that you might have yourself. You know, if you're watching these videos, it's because you're a techie, right? You think you're a market technician, are a technician, want to learn more about that. No different than the rest of us. So what I do is my charts will look like this in the morning. And what I do is I review 40 charts. Actually, it's more now because I've put ETFs in there. And I promise you I'm going to add more ETFs. I'll probably get to the point where I have to add enough ETFs to get away from ETFs and futures in the same. But I cover all these different areas, and I realize that it takes moments to do that. So what we do is we do them in the same way each and every time, the same sequence. That allows you to grab the bottom and draw it wherever you want to be with that chart. What do I do in there? I'm going to tell you what I think the pros are doing, where they're doing it, why they're doing it, and what I'm seeing. And unlike these videos, I can say buy here, sell there, because you can have a user ID and a password to get in, and that's the secret to it. The cost of this? 26 cents a day, my friends. So if you're not willing to pay 26 cents a day to give it a try, I get it. It's too much money for you. Forget it. If you're looking, though, for somebody that you're saying, you know, he's not a broker for me, or he is my broker, but I'm not getting talked into the trade. This is what somebody that isn't on the phone giving me an opinion is. I think it's a pretty cool way to do it. Go to www.iraepstein.com. Go under the words education or research. You'll see morning subscriber video, explains it all. Give yourself a shot at it. 26 cents a day to get started. You decide, and there's no contract with me. I'm Ira Epstein. Have yourself a good weekend. I'll see you Monday.